For months, U.S. stock prices have been breaking records and reaching new all-time highs. And now, key new figures just released show that real disposable personal income grew by 2.8% in the 12 months ended June 30th. What's that mean? Real disposable personal income is a key figure driving the economy. It's the key factor in consumer spending, which accounts for 70% of U.S. growth. 2.8% is the same rate of growth in disposable income averaged in the 6-year U.S. expansion from 2002 through 2008. That's good to know. That tells us a 2.8% rate of growth in real disposable personal income should be enough to fuel a continuation of the current economic expansion. Meanwhile, the unemployment rate declined to 4.3%. That's lower than the best rate of unemployment reached during the last economic expansion in spring 2007, when the jobless rate bottomed at 4.4%. Not since May 2001 has the employment rate been this low. And to give you some context, that was the end of the longest expansion in modern U.S. history. The other important just-released figure shows the economy has continued to create new jobs, 209,000 of them in June, which was more than expected. New job creation and a decline in unemployment have been stretched out because the severity of the Great Recession caused more job losses than in past recessions. The economy cannot keep producing new jobs the way it has in recent years because the U.S. is at full employment or near it. When companies find that their new positions cannot be filled or take much longer to be filled, they continue to operate with open positions and are likely to stop creating new jobs when they cannot fill their current openings. This is likely to happen in the months ahead. The Dow Jones Industrial Average closed above the 22,000 mark for the first time ever on August 2nd. The broader Standard & Poor's 500 has been flirting with breaking its all-time high. At 98 months, the current expansion is the third longest in modern U.S. history, and the good times could keep on rolling. We could surpass the longest ever U.S. expansion, the 120-month-long boom that spanned the entire decade of the 90s and ended with the tech crash of early 2000. A bad surprise could change sentiment abruptly, and a 10 or 15% price drop is possible at any time. However, Wall Street analysts expect earnings on the Standard & Poor's 500 to rise by 18% in 2017 and 12% in 2018, far stronger than the long-term annual average rate of earnings growth of 7%. Combine the earnings outlook with the latest news about jobs and personal income, and the bull run could go on for years. With the 1-2 punch of tax and financial planning, adhering to a discipline of broad diversification, and strategic asset allocation in a low-cost core portfolio, which is periodically rebalanced, is a smart regime to prepare for the best of times and the worst. We are independent financial professionals communicating at a frequency attuned to you. Get financial wisdom anytime from your smartphone by subscribing to our email newsletter.